Welcome everyone to another edition of Late Night on Base. I'm your host, Bill the Bull. We're starting a new series. This is going to be the Crypto Tax 101 series, where every week we'll have, on a playlist, crypto tax information, because it's a very deep topic with a lot of moving parts. And in order to be compliant with, especially if you're in the States, you need to take taxes seriously. So we're honored to have Justin from CountOnSheep, literally probably the number one crypto tax firm out there, that can handle the complexities of crypto. So he'll be our guest every week when we post these videos on YouTube. But more importantly, Justin, how are you doing today?
Doing well, yeah. I mean, it is a busy time of the year for us over here. We're working long hours, but definitely wanted to carve out some time, to talk about tax. There's a lot of confusion on crypto, on what's taxable, what's not, how to strategize, how to optimize. So wanted to carve out some time and make some time weekly for, the show.
Absolutely. No, we're happy to have you. And again, in the description, you're going to have a free, you'll see a link if you're ever curious to have a 20-minute consultation with his team. It's free. So you just have to click it, no obligation at all. And then, like I said, tax deadline is in April, but there's also extensions in play. So whether you're using an extension or maybe you want to use it for the 2025, 2026 return, doesn't really matter. These guys are here ready for all your needs. So today's topic, Justin, is going to be all about tax loss harvesting, because that is one of those areas where not everyone's a winner in crypto, especially on Solana and recently with Libra. For those that don't know, Argentina rugged a meme coin, heavily insider launched. The Solana casino has produced maybe like 5% winners, 95% losses. So, Justin, if you don't mind, can you explain to us what exactly is tax loss harvesting?
Yeah, definitely. Tax loss harvesting, in short, is really just strategically using your losses to offset and reduce your capital gains so that you don't pay more tax than you actually need to. And this is really a strategy that is widely used by, many intelligent, smart investors who are kind of strategizing in how they invest. And it's often overlooked by people who just aren't really thinking about the tax behind it all. They're just thinking, oh, I'm up, I'm down, kind of thinking about it that way. But when it comes down to the taxes, it's all about whether or not you sold that position. So, one of the stories I like to tell is about a client who, like literally was just trading meme coins all year. Like he had probably 10,000 transactions, and he would only sell his winners, right? So he would take the profits, but then he was just collecting this bag of losers, rug pulls, all of that. And so, at the end of the year, we were doing his return. It was in December. Thank God he, came to us at the end of the year instead of in the new year. And essentially, like, we came back and we're like, dude, you have like 50K in capital gains, but you're sitting on 70K of unrealized losses. So you're going to end up paying 50K worth of capital gains unless you just harvest these losses, sell these dead tokens, dispose of them, and then take those losses so you don't have to pay any gains. So yeah, pretty much tax loss harvesting, strategically sell and get rid of those losses to offset, current capital gains.
So by offsetting losses, you're able to reduce the tax liability. And so in your case, the client didn't have to pay anything on his gains because he didn't have any gains.
He didn't have any true gains. I mean, for the year, he had like 50K in some wins, but then 70K in losses. So if he didn't dispose of those tokens by the end of the year, those rug pulls, essentially, the ones that went to zero, he was going to end up having to pay capital gains tax on the 50K in earnings, he had. But you're able to reduce those earnings by the losers that you might have too. So definitely, especially before year end, you got to be looking at that and making sure you're not sitting on any large unrealized losses that you could be taking advantage of.
Amazing. So, and then my question to you a little bit more in depth. So out of that, so if there's a 50K profit, 70K losses, they offset, but you're still left with 20K in losses. Can you carry that forward?
Yeah. So what happens, in that situation, we'll just keep running with that example, is he had 20K of net realized loss, once he sold. And so up to 3,000 of that can be used to offset ordinary income. So you can actually take some of that offset ordinary income, like your regular W-2, and then the rest will be carried forward to next year to be used against next year's gains. And then it's a process that rinses and repeats. There's no expiration, so it can just go on indefinitely. So really, there's really no harm, no foul in taking those losses.
Wow. So it's good for viewers to know that not only can you use losses can be good to offset the gains that you've made if there is a a balance that's still accrued, you can actually use 3,000 of it to offset your income,
Yeah, your ordinary income.
and you can constantly do that every year for as long as 3,000 continues indefinitely.
Yep. Yeah. And then, like in this example, next year, if he had 17K in capital gains, that remaining 17,000 in losses would just reduce that to zero. So his first 17,000 in capital gains is essentially not taxed in the new year.
Interesting. And currently, right now, when you're offsetting gains, there's a short term and a long term, I guess, rate, correct? When it comes to gains and losses, or just gains in general, right? Or is it they're both for losses too? Is it still taxed the same way?
Yeah, so short-term and long-term gains are taxed differently. Long-term is much more favorable, whereas short-term is really just taxed at your ordinary income rate. Now, when it comes to losses, there is some crossover. I won't bore you to death. I mean, maybe we can get into it with a future session. But essentially, the long-term losses will first offset long-term gains, and then the short-term losses will first offset short-term loss or short-term gains, and then they can kind of cross-pollinate. So you still can use like long-term losses against short-term gains, but there's like kind of an order of operations, if you will, before you can do that.
Gotcha. And I think one of the questions too, when it comes to offsetting your gains with losses, talk to us about wash sales. And how does that work? And how does that apply? Because strategically, some people just do that and then
Yep.
rebuy back in to reset the position. So how does that relate to crypto?
Yeah, that's a really, really good question. So for years, actually, this has been a known loophole, more or less, in the crypto space. So for securities and traditional investments, a wash sale is essentially if you sell an asset at a loss and then buy it back within 30 days. That loss is actually not allowed in terms of with the IRS. So they would disallow that loss and not let you take that. But the law is written and it specifies that is for securities. So crypto is taxed as a property, in the eyes of the IRS. And so even Joe Biden, when he was running for president for the 2024 election, he actually said in his budget plan that he wanted to explicitly close the wash loss crypto rule to get rid of that. So even he knows that the federal government cannot enforce the wash sale rule on crypto because crypto is taxed as property, not a security.
Interesting.
And so right now, what we're seeing all the time, we see it on chain, we see it, with our own clients. People are selling those positions at a loss. Like let's say ETH is down for the month. I can sell my ETH, take that loss, and then just rebuy it the next day without
Wow.
having to necessarily wait 30 days. And then I'll reset my basis, but I'll be able to take that loss right now.
Interesting. And so all these strategies are used, and that's actually very unique. If you properly use some of these strategies, you can substantially reduce your tax bill. And a lot of people don't know this because it's a very like there's so many loopholes and it's just a complex field. So for anyone listening, losses can actually be a friend. So Justin, in the sense of like Libra, we have people losing hundreds of thousands, millions. Would you say if you were a client, or if one of those clients came to you, would you suspect that if they use that loss, there's a chance that that would offset all the gains that they've made for the year?
Yeah, definitely. I mean, the way to, I'm an accountant, and this is really the way that I think about gains and losses is when you make a gain. So, like, let's say you made $100, the true gain is the $100 minus the tax that you would owe on that $100. Similarly, and inversely, with a loss, the true loss is not like a $100 loss; it's minus the tax rate. So that you're not experiencing a full $100 loss, you're experiencing maybe only a $70 loss because you're getting $30 in tax benefit. So if you're able to harvest that loss and dispose of that position, you're going to be receiving that tax benefit, reducing your other gains for that year. So really, really, like, seriously, sell the loser, sell the rug pull, sell the coins that went to zero. Because if you're just sitting on those, you are sitting on a gold mine essentially from a tax loss harvesting perspective.
It makes sense too why a lot of the times traditionally in the markets in December, it's pretty down for the most part. I don't know if you've noticed that, but it makes sense because you probably have a lot of people, especially in crypto, utilizing these strategies to sell their losers, and
Hmm.
then they can use that for that tax year because it once the new year starts, your tax liability resets in terms of like like if I need anything I do in 2025 is going to be reflected in my 2026 tax return. So that makes sense because people can wash trade or carry their losses and find that. So I find that interesting. So if you're one of the Libra people, again, I know it's a tough scenario. If you've been a part of the Solana casino, I know it's tough, but it makes sense that even if you have a big loss, there's a chance that it offsets all the gains. So if you're one of the 95% who always loses on Solana, if there's any silver lining, you might be able to drastically reduce your tax bill, if not even have to pay, and actually take away a lot of your income. Justin, what do you think? Because again, these ones I want to keep 10 to 15 minutes because I think they're powerful and every scenario is different. Well, let me ask you this. NFTs are the same way. Can you still, if you buy a JPEG, I guess, and sell it for a loss, the same rules apply, correct?
It's the same thing. And I mean, I don't want to talk poorly on NFTs or anything like that, but what I like to say is NFTs, especially, from the 2021 cycle, those are tax loss harvesting gold mine, essentially. We get clients all the time who they were buying all these NFTs in 2021. There was a lot of hype, and now they're just simply down, potentially gone to zero. So holding those NFTs, I mean, maybe if you want to keep them for a collectible, sure. But what might be a more strategic and smarter move would be to sell it to someone for cheap and then buy it back to harvest that loss and reset that basis. And then that way, you're able to take advantage from, a tax perspective. You're able to capitalize on that loss a little bit and reduce your current year gains.
That makes a lot of sense. I think, yeah, a lot of these NFTs in 2021 hit like 400K, 500K in unrealized gains or something. So if you've held it down, or maybe you bought it at that time, now it's worth 90% less. It might make sense. Actually, it does make sense. Even if you're attached to it, sell it. Again, nothing we say is financial advice, but to me, my opinion is you sell it, you take that, some words up to like 6-figure loss, and then you can just rebuy back in at a substantial rate. And now you have that loss to offset any gains. And if there's a deficit, you can continue to write that off.
Yep. And I mean, one of our clients, this was a higher net worth client, but he was in a token that was substantially down. We were doing his account in, I think, July of 2024. He was substantially down, and he had a $300,000 unrealized loss on this token. But simultaneously, he had about 200K in capital gains for that year. So this is literally very, tangential to the example I was giving about the meme coin trader. So he had these huge capital gains, but he was sitting on a large $300,000 unrealized loss. And so we told him, hey, if you just sell these assets and get rid of them, maybe chill out for a day or two and buy back in if you want to remain exposed to that position, you can do that. But if you sell those assets, you will bring that entire 200K loss down to zero. You won't have to pay any tax rather than having to pay upwards of 60 grand in taxes for that 200K gain. So these are the strategies that you have to be thinking about. The wealthy are always thinking about this. It's very important that you're cognizant. Everyone's focusing on their gains. Like, it's super exciting when you hit it big, when you hit a 10x, but look at your losses, see what you're holding that might be dead, get rid of those to reduce those gains so you can actually keep more of it and not have to pay as much tax.
Absolutely. And my last question to you is, obviously in the United States, you guys you deal with US residents clearly, but taxes aren't just for, you guys don't just work for only Americans. Do you also talk to us? Do you do international, Canada, other tax jurisdictions?
Yeah, we do Canada, we do UK, Australia, pretty much any major nation we're able to do, the tax for. To be honest with you, Bill, the tax is the easy part. It's really the crypto piece that's difficult for most accountants. So that's where we come in. We're kind of like your local degen accountant, if you will. Most of us trade. Some of us are in, the Solana casino, as you say. But yeah, I mean, we're very familiar with the crypto piece, but we're also, formally trained accountants as well. So yeah, we're able to work in kind of, work with the different tax laws in the UK and Canada, Australia, so on.
Absolutely. That's amazing. And like I said, crypto is an international, worldwide thing. Taxes are as well a worldwide thing. And you're right. Not every account, well, there's a lot of accountants in the world, but very few specialize in crypto. It's just not there. They don't understand. They're not one of us. But CountOnSheep is that team, and I recommend them greatly. I wouldn't be having you on if I didn't believe in you guys. So guys, this is the first edition of our weekly series. This was all about tax loss harvesting with Justin from CountOnSheep. We're gonna have many other episodes. We'll have one just strictly on capital gains. We'll have one on airdrops, what's involved there. If you've been involved in the Celsius matter, we're going to talk about Celsius. The list goes on. And if there's something specifically that you want to talk about on one of the future episodes, do let us know in the comments below. And then as always in the description, once again, we'll have a link, 20-minute call with Justin and his team, no strings attached. So if you have any particular questions, that's how you go by clicking my link. Justin, we will thank you for your time, and we'll see you on the next one.
Thank you so much. Nice being here.